Welcome to The Explainer. I am so thrilled you're here today because honestly, we're going to look at something that is actively confusing a lot of very smart people right now. We're breaking down this fascinating concept called market matters, and we're going to demystify what's currently being described as the slow grind economy. As always, the goal here is to organize this information visually so we can truly understand the actual mechanics at play. Let's just get right into it. Okay, let's dive into this. Have you found yourself wondering why the economy just kind of feels wobbly, yet it hasn't completely rolled over? I mean, we constantly hear about a slowdown, we absolutely feel the pinch in our wallets, but we definitely aren't seeing a total catastrophic collapse like we did back in 2008. So why is that? What's actually happening under the hood here? Well, to answer that, we aren't going to start by looking at Wall Street. We're going to start by looking at Main Street, specifically the real estate market. If we look at real estate right now, something has fundamentally changed. Properties are taking noticeably longer to sell. Showings have really slowed down. Now, buyers haven't totally disappeared, but they are way more patient. They actually have the time to look around and compare things. And sellers, well, they're having to adapt by offering price reductions and concessions. But notice that final reality there. There is absolutely no complete market collapse. People are still buying. Underlying demand absolutely still exists. So we've got this weakening demand pushing right up against underlying stability. And, this brings us to an incredibly helpful way to visualize the entire economy right now. Section 1, the economic teeter-totter. The whole reason the economy is stuck in this slow grind instead of a boom or a bust is that incredibly powerful competing forces are keeping everything suspended in a very delicate horizontal balance. The battle is clearly mapped out right in front of us. On the left side, we have these massive downward pressures pushing heavily on the economy. We're talking about really restrictive, high interest rates from the Federal Reserve, severe housing affordability issues, totally stressed out consumers, and that sticky inflation. And honestly, if that were the whole story, we'd be in a deep recession right now. But pushing right back up against all that weight are these massive upward forces. Staggering government deficits, heavy defense spending, something called the wealth effect, and a gigantic physical build-out for artificial intelligence. We really need to examine these forces closer, and let's start with a very strange downward pressure. Take the labor market, for instance. Recently, we saw this crazy scenario where the headline unemployment rate actually declined, but overall jobs were lost during the month. How on earth is that possible? Well, it's due to falling labor force participation. When people just stop looking for work, they literally aren't counted in that headline number anymore. What we have right now is what economists are calling a no-hire, no-fire labor market. Weekly unemployment claims are super low, so businesses aren't aggressively firing people, but they also aren't hiring. So if you already have a job, the economy feels perfectly fine. But if you're actively looking for one, it feels terrible. Two totally different things are true at the exact same time. But remember, the teeter-totter has another side, the forces holding the economy up. Take a look at this absolutely staggering number, $1.9 trillion. That is the projected federal deficit for 2026 alone. That represents roughly 5.8% of GDP, which is way above the 50-year average. So, think about it like this. While the Federal Reserve has its foot slammed on the brake with high interest rates, government fiscal policy has its foot slammed right on the accelerator. This is a massive upward force, pumping money and demand directly into the economy. All that money pays for real contracts, real materials, and real workers. And here's another huge piece of that upward pressure. $918 billion. That's the projected federal defense outlays for 2026. You see, a family deciding not to buy a house because the mortgage payment is too high, well, that doesn't stop a defense contractor from fulfilling a massive government contract. This huge amount of spending moves through manufacturers, tech companies, transportation, and supply chains. It creates incredibly robust economic activity that is completely independent of whether the housing market is struggling or not. Then, we have to factor in what's known as the wealth effect. The stock market and financial assets have remained remarkably strong lately, and when this happens, households that own substantial assets just feel wealthier. They still travel, they're still buying vehicles, they're still investing, and that keeps consumer spending propped right up. This brilliantly illustrates how we actually have two completely distinct consumer economies operating simultaneously right now. A wage-dependent household is feeling the absolute crush of inflation and interest rates, while an asset-rich household is experiencing relative abundance. Section 2. The AI infrastructure boom. This is the newest and honestly maybe the most fascinating weight propping up the right side of our teeter-totter. And spoiler alert, We aren't just talking about software anymore.
Artificial intelligence is actually a massive physical asset story. Think about it. First, you need land. Then you need massive data centers, which require thousands of tons of concrete and armies of construction workers. You need electrical infrastructure, literally building power plants, incredibly sophisticated cooling equipment just to run millions of semiconductors. And now you need Wall Street to finance the whole shebang. The money moves through the real economy, creating this massive wave of physical activity well beyond just the tech companies themselves.
Which brings us to this mind-boggling figure, $500 billion. Wall Street institutions are currently partnering with tech giants to create these huge financing platforms. Their goal? To bring $500 billion of third-party capital right into AI infrastructure. So instead of tech companies using only their own cash to go out and buy servers, outside investors are stepping in to finance it for them. Now, this brings a truly crucial concept into play: leverage. Leverage is really simply using outside capital or debt to control a large, productive asset. It's exactly like putting 20% down on an apartment building and having a bank finance the rest. Tech companies can now lease their computing capacity fully financed by outside investors. Why does this matter to us? Well, because when credit enters a rapidly expanding asset class like this, it allows the economic boom to continue much, much longer than if companies were just paying straight cash. So that leads to a really important question. If Wall Street is securitizing billions and billions of dollars in AI infrastructure debt, who actually holds the risk? If the financial crisis of 2008 taught us anything, it's that incentives absolutely matter. When you create super complex investments and people stop evaluating the underlying asset because they just assume someone else is holding the bag on the risk, well, that's usually when major problems occur. We really have to recognize that financing AI data centers is fundamentally different from financing real estate. A house built today will still be a highly useful, highly valuable asset 50 years from now, right? But technology risk is all about rapid obsolescence. A cutting-edge computer chip financed today might be completely outdated in just 2 or 3 years if the next generation of chips is faster and uses way less power. If you're an investor, these are the critical questions you simply must be asking. What is the actual rental rate of this equipment? How long are the leases? What is the equipment actually worth if demand drops? I mean, we all remember what happened to our cutting-edge flip phones, right? Historically, we've seen massive infrastructure overbuilds before. Think railroads in the 1800s or fiber optics in the dot-com boom. The technology was completely revolutionary, yet the investments still created a bubble that eventually burst. A revolutionary technology and an investment bubble can, and often do, exist at the exact same time. Section 3. What tips the balance? So, with all these unbelievably heavy weights stacked on both sides, what is going to finally break the slow grind stalemate we've been living in? When we build this all together, we see this perfect, tense equilibrium. We've got cooling inflation, but energy costs remain stubbornly sticky. We have a softening labor market, perfectly offset by massive defense spending. We're looking at restrictive interest rates choking real estate, while a $500 billion AI credit boom injects wild amounts of cash right into tech. We've got squeezed wage earners, countered by the wealth effect of asset owners. This right here is exactly why it's kind of foolish to make dramatic certain economic predictions right now. The teeter-totter is dead horizontal. So, I pose this question directly to you. What changes first? Does inflation suddenly surge back? Do interest rates finally come down enough to free up some capital? Or does the labor market finally crack and just pull the whole thing down? One side is eventually going to overwhelm the other, but make no mistake, neither side has won yet. Section 4. Real estate in the middle. Let's bring this highly complex economic chain back to practical application, because housing sits right smack in the crossfire of all these massive global forces. Here is the stark reality of the current housing gridlock. Buyers desperately want lower monthly payments. Sellers are stubbornly clutching yesterday's high prices like it's a winning lottery ticket. Homeowners are sitting on record amounts of equity, but giving up their current 3% mortgage to access it is just simply too expensive. And investors? Well, they're hunting for deals that actually cash flow in a high-rate environment. Literally everyone is just waiting for the other side to blink. It is the absolute perfect definition of a slow grind. Which brings us to a really crucial concept. I'm waiting for rates to come down is not an investment strategy. We absolutely must understand why they are coming down. Look, if mortgage rates fall because inflation has been totally cured and the economy is super healthy, hey, that's great for housing demand.
But if rates suddenly plummet because the labor market has cracked and the economy is crashing, well, that is a very dangerous time to be highly leveraged in real estate. The why matters so much more than the what.
So, how do you actually navigate this? Well, you start asking the tough questions a trusted advisor would ask you. What is this property actually worth today, not 2 years ago? Can you afford it if your assumptions about refinancing are completely wrong? What happens to your game plan if rates stay higher for much longer? Where's the real long-term opportunity, and where's the hidden risk hiding? This teeter-totter economy requires us to be highly analytical, not emotional.
I want to leave you with this foundational philosophy from the source material. Wise decisions come from understanding today's conditions rather than wishing for yesterday's. The market matters. The economy matters. But understanding them, that gives you the power to act rationally in an incredibly irrational time. So as you look at your own local market and your own investments, you really have to ask yourself, are you building your financial future based on hoping for a magical return to 2021? Or are you strategically positioning yourself for the realities of the slow grind? Think about that for a bit. Thank you so much for joining me on this explainer, and I'll catch you on the next one.